As commercial banks shift to a new risk-based pricing model pegged on the Kenya Shilling overnight Interbank average, Kenyans with poor credit history may soon face higher borrowing costs. Central Bank Governor Kamau Thugge says the model is not meant to lock anyone out of the financial system, but high-risk borrowers will pay more compared to low-risk ones. Jimmy Mbogo with that report.
In the next 3 months, commercial banks are expected to have transitioned to the new risk-based credit pricing models, with new loans expected to be priced using the new framework beginning December 1st. But the framework, whose aim was to unlock credit to the private sector, could have dire consequences for Kenyan borrowers with poor credit history. Unlike the previous framework, which had been in place since 2019 and required the approval from the central bank, the new framework will only require approval from individual banks' boards, an issue that could see interest on loans disadvantage some segment of the population.
If you are a very risky customer and you don't pay your loans on time, it's not that you are prevented from accessing credit. The credit will be there, but the price will be high.
The central bank pegging its hopes for lower rates on the openness that will be brought by the new framework, hoping that it will serve to push competitiveness in the banking sector and ensure Kenyans enjoy lower rates or move to banks that will offer credit at a lower premium K, which comprises of the bank's operating costs related to lending, return to shareholder, and the borrower's risk premium, having standardized the base rate for all banks. Unlike what was the case previously, where banks had different base rates, making it difficult for borrowers to determine the bank with better offers.
Under the new framework, yes, the base is known. The K, we will be able to get the details of the K as the regulator. Yeah. And, for the risk part, we'll be able to look and see whether it makes sense from a qualitative point of view, a quantitative point of view, so that it's also not used to as a way to just raise rates without really a foundation for raising the rates.
To ensure compliance, banks will be required to report both their average lending rate and their average premium K monthly, with the regulator expressing optimism that the new framework will bear fruits, arguing that the previous framework was skewed to banks' advantage.
When the rates would go up, the commercial banks would immediately raise their rates. But when the time came to really stimulate the economy and get more credit going to the private sector by reducing the policy rate, the CBR, we saw some reluctance on the part of the banks to lower their rates.